Hello and welcome to Macro Mondays. I'm James Todd, Trader Performance Manager here at Onyx Commodities, standing in for James Brody.
I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
And I'm Ed Hayden-Briffett. I'm also a research analyst here at Onyx Capital Group.
As always, we'll be talking you through key market data, charts and risk, as well as some of the significant headlines over the past week.
We'll be unpacking a new ruling that might see Trump's tariffs proved illegal. We'll also be diving into gold price action, which approaches all-time highs.
We've also got some GDP data, as India's GDP hit an incredible 7.8%, while US GDP was revised up in its second estimate.
Yeah, so to kick things off, obviously there was a Court of Appeal ruling this last week on the tariffs that Trump has been implementing. This is one of many sort of swings in the tariff story, and it seems as though it's sort of going against him, going against Trump right now. But is this a significant development?
I think it is, but I think mainly it's a good time to be a lawyer, right, in the Trump administration, because you've seen numerous legal challenges. This is probably just the latest one. Clearly, Trump's taken to Truth Social to express his outrage at the ruling, and he also said that they will stay in place, these tariffs, until some kind of final verdict is reached. But it's also interesting that the ruling came 30 minutes after the futures market closed for a 3-day weekend. It's kind of a convenient coincidence of timing. And then you also have the conspiracy theory over the weekend that Trump's dead, which came out on social media somehow because of Vance saying that he was ready to take over. So really, it's just been a bit of a wacky weekend from the US, frankly.
Yeah, definitely. I mean, you know, I saw some photos of Trump on a golf course, etc. So, but whether those are legitimate or not, who's to say? But yeah, I don't know. I just find all of this, the legality, the sort of actual implementation of tariffs, it's always been a murky story, a murky picture. And to have it, you know, Trump seems to be very zealous about things and overly so, I think. And, you know, a lot of his language saying this money will go directly into US consumers and we're going to make other countries pay for this sort of stuff. It oversimplifies what is ultimately quite a complex issue time after time. And to see whether, you know, to discuss even whether this is within his realm of influence is a whole other thing.
Yeah, definitely. And I mean, it just adds to the whole uncertainty of the tariff policy. I mean, people don't understand necessarily how to react to a lot of these decisions. We don't know how long tariffs are going to be implemented for. There's been a lot of flip-flopping, and now whether tariffs are even legal or not is just going to add fuel to that fire. And I think it's going to be, you know, it's difficult to do business with the US in these scenarios.
Yeah, and it creates uncertainty going forward. And then sort of on the topic of Trump overstepping his boundaries and adding uncertainty. We've seen a huge amount of uncertainty over the past fortnight or so with him supposedly firing Lisa Cook, to which her reply was, well, you have no authority to fire me.
Yeah. And you've reached a point of absolute absurdity when you've got a sorority coming out and expressing its formal support for Lisa Cook. It's just frankly, like Will said, how can you do business with a country that you can't take seriously when this kind of thing is going on? And
I mean, it's important to stress that, you know, that the president does have the right to fire Fed members should there be cause. But in the absence of any sort of criminal conviction, that is very difficult to see any sort of cause there. It's more in response to him trying to achieve some sort of power over the Fed, and I don't foresee it materializing. And if it does, that's a significant challenge to central bank independence.
So you don't see it materializing in terms of Lisa Cook being actually removed, or
I don't see that being a. I mean, obviously, who knows? But I think it's very unlikely, and I think it would be a direct challenge to Fed independence. You know, and that's been a cornerstone, a pillar of economic policy since, you know, the RB&Z first went independent, and then we had the Bank of England go independent in 1997. And it's been one of the big success stories. If you look at inflation, it's remained relatively around target other than like the COVID pandemic era.
It's sort of you do wonder, of course, whether if she were to be removed, and then I guess the question is this a witch hunt, or is it due cause and due process being there? And it sort of ties back into what Ed said at the top of the show, like good time to be a nice, well-suited lawyer in the US, because there's going to be so many challenges and everything like this. But of course, if Cook were to be removed, I'm sure it wouldn't be too long before Jerome Powell's found to have had some indiscretion and hadn't paid his parking tickets or something. So I suppose with all of this uncertainty in the US, you're seeing some alternative asset classes and precious metals seen as, especially gold, seen as an alternative to equities and US bonds. That's been unsurprisingly supported. So we're coming up to, it's sort of challenging all-time highs yet again. What do we think about this? We're going to break up or down?
I think it's going to keep going. I mean, we said last week we were kind of is gold about to break out, and it broke out to the upside there quite aggressively, and I think it's going to continue. It seems pretty broad based. We've got a silver chart in a minute across precious metals. So I think that's a key support line there that we've just crossed, and I think it could go further.
I think as well with the tariffs, because it's an uncertainty story more than actually the tariff story itself. Is more people don't know what's going to happen in terms of US policy, in terms of trade policy. So I think the precious metals is a good trade to be in at the moment. And we aren't seeing, because of the holiday, today, we aren't seeing an equity market reaction yet because the US is out for the day. So maybe we'll see that tomorrow, maybe we'll weaken again on the open.
I think in reference to gold versus other asset classes as well, or precious metals as opposed to other asset classes, you never see as much rhetoric and accusations of bubbles being thrown at gold. Everyone knows that to some extent gold has no inherent value, but it has all of this inherent value to some degree. So when you see the S&P, absolutely roofing, and people are saying, "Oh, price to earnings ratios are blown out. This doesn't make sense anymore." Let's go for an inflation-proof asset class, i.e. precious metals, and let's just support that. So just because gold reaches these all-time highs, it doesn't seem to find as much criticism. It's an interesting thing to look at. But then, we'll come to talk about Bitcoin later in the show. But whilst precious metals have sort of really found support in this period of uncertainty and worries about inflation, crypto has been supported, but in this recent uptick in gold, we haven't seen that being matched by crypto.
I think there's a lot of concern over the dollar as well. We've seen that kind of continue its downtrend, and I think that will be aiding gold here. People will look for a safe store of value as a hedge on inflation, but also dollar debasement. So it's a bullish scenario going forward.
And as you've referenced, silver also coming up to, well, not all-time highs because of the crazy price action that there was in 2011, but this is sort of probably pushing a 10-year high there. Which would you prefer to go in for here, silver or gold?
I think gold still is the gold standard. It's the natural first port of call for anybody looking for that alternative precious metal asset. So I think silver is really more of a kind of result of the gold boom than itself.
Yeah, I mean, people trade these as ratios. So as soon as you see a big move in gold and not a comparably big move in silver, then I think it's a good time to buy silver. But I think ratios have been holding relatively firm. So I think, gold would be my preference here. But what about you, James?
I don't know. I'm tempted to agree with everyone and say gold, because if we do get a breakout above this all-time high that it is tested repeatedly, then you could see some quite significant price action as anyone that's short at these all-time high levels sort of gets washed out. You see new longs coming into the market, but that's predicated on the assumption that we do settle above the all-time high over the next couple of days, whereas if we were to be hit that all-time high, come off again, I still believe in precious metals as an asset class to invest in, and silver doesn't quite have that same toppiness to it at these levels. So those are my thoughts on the precious metals. seen. And then, let's look at a bit more macro data. So PCE, we saw it slightly mixed last week.
Yeah, I mean, I think, heading into the PCE print, the market was looking at a hotter than expected PPI and a core CPI that was a little bit hotter than expected. So I think the market was pricing, a pretty robust print, and we got 0.3% month on month. As markets expected. Now, it's important to stress, though, that like if you were to annualize that, that's about 3.7% year on year. So this is on the hot side, given the Fed's target of 2%. But I would say that a lot of this is being weighed on by gasoline prices, as we'll see shortly. So really, the focus here should be on the core measure. And I think, it'll be a concern for the Fed, that's for sure, even though we did see Powell flip dovish at Jackson Hole.
Yeah, I think that's, again, to go back to the gold story, that's part of what's driving it. Again, is these rising inflation expectations. You're starting to see it in the first indicators in the PPI that you mentioned, CPI as well, beginning to hot up again. So I think there is certainly a desire by many investors to get ahead of the curve and be hedged before inflation picks up too high again.
And you mentioned gasoline prices. Obviously, they are, a significant contributor to any consumer's expenditure, whether direct or indirect, and it has a leading impact on inflation. But what was the Trump rhetoric going into the election, and what are we seeing in retail prices for gasoline?
Well, it was, we're going to bring gasoline prices down below $3 was kind of his target, and gas body data is showing it's down to an average of $3.17 per gallon in the US. And then you obviously have Trump and the White House boasting about the lowest Labor Day gasoline prices since 2020, which obviously is when he was in power again. So you've immediately got this kind of I beat Biden kind of rhetoric comes out of Trump and the White House. But like Will said, gasoline has been weighing on the inflation and trying to anchor it down a bit.
Do you think this is Trump policy coming through, or do you think it's a soft driving season?
I think a bit of both, frankly. But no matter the cause, the effect is quite clear, because you can see on the graph, you get to kind of September 2024 and the prices come down pretty suddenly. And then they're kind of nearer to where we are now, just above the $3 per gallon range. So that negative impact it's had on the inflation metric will be filtered out in the coming months. So I think we could then see that the kind of headline inflation does begin to pick up again.
Definitely. And that's why it's important to kind of look at the core measures, which strip out volatile components like energy and food. They give a kind of a better picture of the underlying inflation dynamics in the economy. And that has been remaining pretty firm, even though we've seen the headline come off a little bit. And that's really what the Fed is going to look at, because that's almost the true inflation in the economy, stripping out exogenous factors.
It's quite a good point. Well done. And okay. So equities now. NVIDIA. We saw strong earnings, but price, the NVIDIA price didn't sort of absolutely rip off the back of that.
It's like we've mentioned with China, for example, it's a slightly analogous approach, but China, bad news is good news, right? Because bad news means more stimulus. For NVIDIA, good news is only good news when it means more good news down the road. And because they've reduced their forecast and they haven't been upping the forecast as aggressively as they were in previous earnings, although the revenue was still really strong, it was record revenue, the stock dropped by 5% on the earnings call. So NVIDIA, it's just carrying so much hope and expectation from the market. And if it begins to underperform in any metric, you can see a pretty sudden and aggressive correction, as we did on the earnings report.
Yeah, definitely. I think it's one of those cases where unless we see an exceptional earnings, then that will not have been priced by markets, because these ratios, the market is expecting big things from NVIDIA. Yeah. And if they don't deliver even in their own expectations for the future, then that's the price for action results.
It's also worth noting that the sales to China were way down due to the chip export restrictions. Yeah. So you've immediately got a massive market that's been cordoned off effectively from NVIDIA's revenue stream. So unless you can get some kind of resolution on the trade front, which again comes back to the Trump trade policy, then they are going to have some more difficulty than maybe the market expected.
Yeah, I just think it's sort of worth reiterating for the umpteenth time, how big an impact retail has had here. And so much of the price of NVIDIA as a stock is based on blue sky thinking and FOMO. Yeah. And when you have, every single best case scenario is kind of priced into NVIDIA somewhat now with these price to earnings ratios. It is absurd. It doesn't mean that it's going to be coming off, but that is implicitly some of what has driven the stock up. And so when you see any of the telltale signs, if parts of the Jenga tower are starting to be removed, it can really weigh heavily on these things.
Definitely.
And with forecasts, if you're talking about FOMO in particular, people are like, mentally saying, well, this is going to go to NVIDIA could be the next Bitcoin. Of course, I'm going to be, foolish to miss out on this. And then when forecasts are revised down, people start to think, oh, maybe it's not. Maybe I'm not going to be seeing this as another buying opportunity.
Yeah.
So I think it's an interesting one to watch, of course, but it's you're just dealing in such ridiculous numbers at the moment.
Yeah.
It's hard to know what to think of it. And then Eurodollar. We've been seeing that sort of somewhat range bound. I don't know, it's a bit of a tricky one as well when you have yields in the US, similarly, the uncertainty in the US kind of being matched toe for toe with uncertainty in Europe at the moment.
Yeah, I mean, it's true. We've seen kind of the treasury curve in a bit of flux recently. It's been a pretty aggressive bull steepener there, with the twos kind of really dumping at the front and then people selling the back. So, I mean, and 230s has been ripping as well. I think that's going to be adding uncertainty for the dollar, which will be a headway. People don't want to hold that deferred US debt. At the same time, we're now expecting a more dovish Fed, so that's pushing down the front. But Euro is also an interesting case as well, because from a kind of monetary policy perspective, I think they're going to have to start easing much more aggressively. And as we discuss the OIS pricing later, there's not really that much priced. And I think they're going to struggle to hold the rates as they are. It's clearly over restrictive still. So,
and you mentioned as well the lack of desire and appetite for the longer, more deferred US treasuries. But you've got France as kind of the counterbalance to that on the Euro side as well. And we're going to come on to that in a moment. That, the French fiscal sustainability story is one of kind of a dire outlook. So there is that counterbalance as well, and we're going to come on to that in a minute.
Yeah, but before we do, let's look at US GDP as well. So we saw some significant revisions to US GDP. That old adage of there are lies, damn lies, and statistics. We're just seeing data constantly being revised. Is this a significant revision that we're seeing last week?
I think so, because it went from the first estimate of 3.1% to the second estimate of 3.3%. So it's already not just kind of a rounding error, perhaps. It's actually significant. And one of the major drivers was the investment statistic, which was revised up significantly from the first estimate. So there is clearly, the faulty abacus has struck again. Yeah. But there's also the export-import story, which has been really driving the quarter-on-quarter change.
And I think that's the more important one here, actually, because a key reason for US GDP printing softer in previous quarters was due to front-loading and huge amounts of imports. So then when we saw that flip the other way around, so that imports were revised down from 30.3% to 29.8%. So that's going to boost the GDP statistic. Perhaps tariffs didn't have quite as strong an impact as we expected them to. And then, as you were saying, at the same time, we've had a stronger investment print. So that is material for the market, that information. You need to know what the drivers of the GDP print are. In order to create any sort of view forward. And if the Bureau of Labour and Statistics are getting the payrolls wrong and the Bureau of Economic Analysis are getting GDP wrong, what can you look at? How can you get any sort of guidance on how to position moving forward.
Well, and it makes it particularly treacherous for people that would trade that headline, or maybe even algos that will just be scanning. Says, oh, doesn't meet expectations. The algos will sell, and then positionally you'll have sort of got it wrong if things are revised on a looking back basis. And moving on from US, but sticking with GDP, Indian GDP was pretty bloody good, wasn't it?
Yeah, I mean, 7.8% year-on-year growth in July against the expectation for 6.7%. So they've beaten it by like 1% or even more. So frankly, India, I was certainly a little bit concerned that India was beginning to slow down. Their inflation figures were looking a bit ropey, while the RBI's interest rate is still very high. It's above 6%. Still, it's incredibly high given their inflation is dropping as fast as it is. But yeah, the Indian GDP was a phenomenal print, and I mean, the chart here shows you the 10-year Indian government bond yield, and it did really bottom out in the spring, and it's been climbing since. So I think India definitely isn't. There is still legs for the Indian economy, certainly.
And it's interesting as well, obviously imports. So imports rose, they're up almost 11%. And say, imports are up, so you're very dependent upon, trading partners, pretty much all of whom are experiencing significant inflation. To have a high interest rate and yet it, not be sort of succumbing to a lot of these things, food import pressures that are plaguing a lot of other countries. It's quite interesting. Yeah, and then the Nifty 50 though was almost telling, well, not the same story at the very least, not singing off the same hymn sheet. You almost have a contrasting Indian GDP and equities to the US, where US GDP hasn't been supported, but equities sort of have.
I think it's the old adage that the stock market is not the economy, right? Because last year we had the Nifty 50 flying. It was up to all-time high after all-time high. It was incredibly strong. And then this year you've seen it come off quite considerably. So it really does just go to show that the strong GDP doesn't necessarily translate into a strong stock market, and vice versa.
I think it's also important to remember that, stock valuations are based on expectations, whereas the GDP is obviously lag data. And looking ahead, we have 50% tariffs on India at the moment. They're starting to short relations with China, but it's more difficult for them to reroute exports in the same way China have done. So I can understand why there is a little bit of apprehension around stock valuations in India, and I don't think we've seen the last of soft India prints. As you pointed out, their monetary policy stance is really quite restrictive, whilst we have inflation borderline freefall. So we're going to have to see pretty aggressive cutting there if that's not to weigh on GDP. And that obviously happens with a lag, so we won't expect that to pass through for at least 6 months, even if they start easing aggressively now. So nevertheless, I think, we did have a very strong GDP print, but that doesn't necessarily give me huge amounts of confidence moving forward.
Yeah, agreed.
And so Chinese data, we're still seeing some weakness there as well. So PMIs were weaker than expected.
Yeah, I mean, the manufacturing was like 0.1 points below the expectation of 49.4. But the longer term story is that it's been in contraction each month since April. And for China, who obviously is so dependent on manufacturing, I mean, you can see January is a downtick as well in contraction, but that's kind of a bit of a fuzzy number given the Chinese New Year holiday does have a major impact on their market. But for a Chinese economy that is still very much manufacturing dependent, it's not a great sign that things are all cushed together there.
No, I'd agree.
I think it's more the same kind of overcapacity in the manufacturing sector. Yeah. There's only so long you can maintain a huge supply surplus before some of that surplus has to be cut back. And I think, if you look at the refinery complex, for example, state-owned refiners have been up in their run rates, and they're turning again. But if you look at the independents in Shandong, they're still around 50% capacity. And I think that's going to be mirrored across a lot of the industrial sector in China, as the state is able to support a lot of the excess supply, but the private sector is really going to struggle to maintain those levels.
And in terms of the state picking up the tab, we're seeing that narrative continue with another round of stimulus, basically.
Yeah, so we've seen net injections through open market operations from the PBOC increased pretty materially. I think we discussed it on a previous podcast. There's been heightened liquidity concerns in China, and one effort to counteract that will be to increase net injections after maturities are offset. And I think we'll continue to see that. I think we will also start to see a little bit more targeted stimulus from the CCP as well. I think that's going to come in, and we'll probably have another cut by the end of the year from the PBOC. So they're starting to wind up the stimulus cannon again.
Yeah. And so drawing back on the conversation where we were talking about US versus Europe, I mean, the dire situation in Europe, and particularly France, seems to be sort of getting exacerbated. And talk us through what we're seeing on the chart here.
Yeah, well, you can see that the French yield versus German yield, the Oat-Bund spread, that's just been widening incredibly rapidly this year. And that's partly due to the French political system, I think, and where they've got such a deadlock in parliament. They've been through a prime minister in like 3 months. The new one's maybe only the last 9 months. So frankly, the faith in the French political system is waning. Plus you've also got the mounting debt concern and the serviceability of debt, which we'll come on to again in a moment. Plus now you're hearing some kind of rumors, like headlines coming, does France need a bailout? What's going to happen with the French debt? They are, I think now, by memory, the third biggest national debt in the world. So, and they've got a much, much smaller economy than the likes of Japan or the US, who can support more debt. So the situation for France doesn't look great on any front, in my opinion.
Yeah, I would agree. And, we've been seeing over the past 6 to 9 months, all of these headlines saying, long-term French debt is now more risky than Greek, etc. Which, yet again, that's always, or in the context of the past 15 years of 20 years of global economic development, seems to be a telltale sign that French economy seems particularly damaged, and the debt is absolutely out of control as well.
And I mean, if you also just looking at the Oat-Bund spread, bund yields have been rising as well. So that just tells you how much those French yields are rapidly appreciating. And if you look at CDS as well, that's been ripping. So the market is pricing in a material risk to fiscal sustainability in France.
And just on the headline that we're showing here, so French debt service to ratio is rising, and the cash flow that they're going to be required to, it's a common issue amongst many developed economies, right? A lot of the economic development we've seen has been predicated upon large amounts of debt over the past 50 years or so. But in France, it seems to be getting to, perhaps like critical levels here.
Yeah, it's particularly concerning when you see that they're starting to take on debt in order to pay for previous debt.
Yeah.
And it just becomes effectively a spiral.
It becomes a self-fulfilling prophecy in a way, because the more that you issue, the higher yields go. So the more that you have to issue to cover that yield.
It's like a person with a credit card addiction.
Yeah, and as you said, one reason that, say, perhaps people may be less worried about US debt is that they can grow. They still have a relatively productive economy relative to France and Germany, which means that your tax receipts should also grow. Equally, if the Fed is perceived to be more open to a higher inflation environment, then that can also erode your nominal debt. So the thesis for France is just not the same as that. They will struggle to grow their tax receipts, and they have pretty low inflation. So it's looking dangerous.
I think we'll struggle to tax consumers anymore as well without.
Given the French populace has quite a proclivity for protesting as well, it won't be popular.
Might be a good time to invest in some yellow shares. And then just to sort of round things up a bit here, Bitcoin, it's broken its support level, so it's dropped below $110,000. But you were saying last week, I think, well, at least in your mind, the round number of $100,000 will probably be the proper support line that it gets. Do we see this one as an immediate short, an immediate buy, or are we just sort of agnostic?
I mean, to me, I think we've still got further down to go. I think, that 100K level will prove a pretty important support. And if we break lower than that, then it could really start to free fall. But I think we'll struggle to get below 100K.
Yeah, it is interesting, like you said before, the divergence between Bitcoin and gold, and also Bitcoin and the equity market.
Yeah,
because they had been quite closely correlated. It's rising and rising, as particularly with the equity market as a risk-on kind of asset that you were seeing rising earlier in the year. But since kind of, a couple of months ago, it's just been on a kind of steady downtrend. And I think the question is really what's going to come in and stop it. The headlines, you keep seeing a few like seeping out about the US building its kind of crypto reserve, but that doesn't seem to be having the impact that it once did. And I think it's just another symptom of this headline fatigue that we're seeing across markets.
Yeah, and recently we've seen a couple of like particularly big wallets start to liquidate their positions there, which has weighed on on Bitcoin. But yeah, I think for now we're capped at 100K to the downside.
Cool. And then to finish up, the OIS pricing forecast for the next 12 months. Have we seen any significant changes there? Fed still looks pretty in line with where we were last week, etc.
Yeah, I think the interesting one really at the moment is the ECB, because like Will said, there's really not a lot priced for the coming meetings, and only 18 bips over 12 months. If you're concerned about European growth, then you'd be hoping to see a bit more than that shortly. So I think that, like Will says, they might have to shift somewhat to be a more aggressive cutting stance.
Yeah, I'd agree with that. And then key data releases that we're seeing in the coming week. So things to analyze, I suppose, next week in hindsight. We've got EA inflation flash on Tuesday and the ISM manufacturing PMI as well.
On Wednesday, we'll have Australia GDP, JOLTS, and factory orders.
And then on Thursday, we've got the Euro area retail sales, US balance of trade, and the ISM services PMI. Then finally on Friday, we've got the big one to start the month is the NFPs from the US, plus UK retail sales.
So yeah, it'll be interesting, especially seeing what payrolls say. I mean, they will more than likely be revised after the fact as well. But so, I would advise not trading the headline and looking a bit beyond that. But in the meantime, thank you very much for listening. And we actually won't be here next week as we're taking a week's break, but we'll be with you 2 weeks from now. So thank you very much.
Thank you.